Like good evening to all of you. And it's nice to be here again. We have speak something on new companies. And I recollect somewhere, I think it was in February or March, that the chamber had a similar program, the IMC, where things were still not as clear as they are today. Things are today much clearer. Though things are today much clearer, we are expecting that they become still more clearer because we are expecting a lot of more clarifications to still come into the Companies Act as such. The three things which we are going to cover today are RPT, which is related party transactions, loans and advances, and deposits. And though they are simple things, I think once our office also started making this presentation, it went on and on. So finally I have to say I have to speak only for so much time, so now please cut down the presentation. Because so many issues came up once things were compiled and other things. Now normally any presentation on this Companies Act in our office, we always start with this background. We need not really go through this, but there are some things which you still need to know. We have this 470 sections, all the sections are still not notified. Now we have got this 9.5 lakh companies across India who are going to follow this new act which is there. This is something which I do keep on repeating, that we have got described almost 420 times. So we will have 420 cases almost where we will have rules which will be described. The special resolution is down to 74, central government approval down to only 15 times in the act. The surprising thing is this imprisonment, 76 plus 15, which is more than 100 cases. You have got imprisonment, and we see in almost all the three things which we are going to cover today, it does have imprisonment as a penalty. So what is therefore, because of this, what is therefore going to happen is, in the earlier act, a lot of people used to take chances that, okay, what is the worst thing which can happen? So the worst thing could have happened in the old act was maybe a fine of 25,000 rupees, or maybe if you receive a compounding notice, okay, you go to the company law court, plead guilty and say, okay, we can give a penalty of say 50,000, 1 lakh rupees or something. Things are not going to be so simple. Things are not simple because the penalties are multiple times now, and in most of these cases there is imprisonment or prosecution which will be launched. So it is not going to be as simple as saying that, okay, let's take a chance and we'll see as and when it comes. So that is one thing which I think we have to be careful when we advise clients, especially on these three sections or these three topics, where earlier a lot of chances have been taken on accepting deposits or giving loans. Some of those chances, if you now take, your client runs a much higher risk. Obviously you don't run the risk because this is all done by the company, but the client will run a much higher risk. So we need to be careful on advising clients on these three topics as such. So far, all the sections are still not operationalized. You still have almost 1/3 of the sections which are not yet operational. So if you see, so far about only 282 sections are operational, sections or subsections. There are still more than 100 sections which are still not operational. Most of them are relating to MFRA, are relating to the National Company Law Tribunal and the MMA provisions. Most of those sections are still not operational. And we have got draft rules which came in September, October. Final rules, the first set of final rules came in February on CSR, because just before the election was announced. So that is where politicians would have benefited for CSR, so they announced before the elections. Everything else came in the last week or the last 3 days of March. All other rules were really, final rules were announced in the last 3 days of March. Drastic changes from the draft rules to the final rules. So in some cases, we don't even know who made that representation and how that final rule came, because there were drastic changes from the draft rules to the final rules as such. These are 4 sections of the Act which are very interesting sections. And the last one which is there is not there, in fact, in most of the other legislations in India. The first one is section 462, where the government has the power to exempt a class or classes of companies from provisions of the Act. And if you know, before 2 days, the government has invoked this section to give relief to private companies from several sections. Now that notification is under 462 because they have that power to exempt some companies or a class of companies from the certain provisions of the Act as such. This, however, has to go through the Parliament. So this notification is a draft notification. After suggestions till 1st July, it will go through the Parliament, which is not expected to resist much, and then it will be incorporated in the Act as such. You have got 467 where you can alter any rules, regulations and all, and this they don't need to go to the Parliament. This can be done by the MCA itself, by the secretaries themselves. 469 is the power which gives them to make those 400 and all rules which are there. So the rules come because of 470, the notifications 469, notifications come because of 467. Some special things for exemption will come because of 462, which requires Parliament approval. And the last thing which is interesting is, if there are any difficulties which are found in the implementation of the Act, the government has the power to issue orders. And these orders does not need Parliament approval. Because it's a special section incorporated in the Act for a period of only 5 years. So these orders can be there only for 5 years. And so far 4 such orders have been passed, as you will just see in the list which follows. This is just a list of the notifications which are there. You have this in your thing. These are the circulars which are issued under 469. You see the last set of circulars were just issued before 2 days on 25th June, and that is one reason why I delayed sending the presentation. In fact, on Monday you may find that there are some more circulars or notifications which have come, because it's a ongoing process. Every day you may find some new things which are coming as such. You have got this orders under 470 on removal of difficulties, and we have got 4 such orders. You see one of these orders in April 14, which we are going to discuss today in this related party, that or was made and. The earlier section had or, they just made it and. And this is a big change in the Act itself, but they could do it because of this power available under section 470, which otherwise you cannot go and change the legislation as such. For 13-14, obviously when everything came during the last few days of March, doubts were expressed what happens to the 13-14 accounts, whether new provisions apply or the old provisions apply. But the clarification came right away on 4th April that in respect of financial years which commenced before 1st April 2014, the earlier Act which has governed the rules, scheduled everything as far as financial statements are concerned, and the auditor's reporting is concerned. So when you are doing the audit, when you are giving your report, when the directors are giving the director's report, the old provisions of the Act which would apply for 13-14 as such. However, if you look at the sections which are there were several sections which were operationalized on 12th September itself, and some of these sections do play a role in the finalization of 13-14 also. And whatever is highlighted here in this slide are what we are also going to discuss today, because these are sections which does apply to your 13-14 accounts also. So though other things don't apply to you, these are things which can still apply to you, and that's why you need to be clear about this list of which are the sections which can still be relevant for the statements of 13-14. Fine. This simple background, this is what we are going to cover, and this is the order in which we are going to cover. We start with deposits, go on to loans and advances, and then finally go on to related party transactions. On deposits, lot of discussion, lot of difficulties, everyone says there is a lot of difficulties, and there are a lot of exemptions given earlier, now not given, and so on. We'll see what these deposit rules are really there in this new Act as such. Obviously, you start with the definition of deposit, and it says any receipt of money by way of deposit or a loan or in any other form by a company, but does not include such categories which may be prescribed by the Reserve Bank of India. And that section 73 says that no company other than those specified in the rules will invite, accept or renew deposits except as provided in chapter 5, which is that section 74, 75 and so on. Now the companies which are therefore automatically not covered with these sections are banking company, they can accept deposits, NBFCs can accept deposits, housing company, this is a new thing. Earlier they were included, now they can also invite deposits, and any other company which may be specified by the central government. So far they have not specified anything, but they can specify more companies or a class of companies who will be exempt from this deposit provisions as such. If you go to the rules, it says that when you accept a deposit or when you have accepted any money, everything is covered by the rules except the following things which are not considered as deposits. So whatever you receive is a deposit automatically, except this 7 or 8 things which are listed down here, which are not going to be governed by these rules which are there. Now which are these things? And this is an important list, because if you can fall within this list, you are not going to be governed by the restrictions contained in this deposit section as such. So if you have taken money from the central government or a state government or anything guaranteed by the government, either as a loan or a facility, then you are out of this deposit rules. Obviously anything you borrow from the government, you are out of all these rules. If you accept any deposit from any other company, you are out of these rules. So ICDs, which earlier were also exempt, are also now exempt under this particular rules which are there. If you have received anything towards subscription of securities, they are exempt subject to certain conditions. So if you have got share application, which is what we typically understand as money received towards subscription of any securities. These securities could be anything now, it could be shares, debentures or anything, reference shares. The exemption is available only if you are going to appropriate this against securities, which have to be allotted within 60 days. So once having accepted money for securities as a share application money or a debenture application money, within 60 days you have to appropriate and issue shares or debentures against it. If you cannot do so, you refund it within 15 days, a further 15 days. So the maximum period you will be able to keep a share application money is now only 75 days, 60 plus 15. Now this is, I am sure, very obvious why this restriction has come, because we know a lot of companies, especially private limited companies, who have kept share application money from last 5 or 10 years also. And they say that no, this is not covered as a deposit because it's a share application money as such. So obviously if companies are trying to misuse the provision, they will come out with such restrictions which are there as such. And if you try to be smart and say that yes, I have taken share application money, but after 60 days I will say that this was against something else and I don't refund it and appropriate against something else, that is also not allowed. You have to either refund it or allot shares against it. You cannot even adjust it for any other purpose, because that is not treated as a refund then. Maybe you can refund it and then again take the money for that other purpose, but just adjusting it is also not allowed as such. And you obviously need a declaration that the money is from the own funds, and which also applies to directors. That directors you can borrow, the exemption is there like earlier, with the direction that it is from your own funds. Now, a lot of people say that when you are auditing a company where you are also auditing the books of the directors, and you know that the directors have borrowed money and then given it to the company, what is your responsibility from the angle of the audit of a company? The answer to that in my view would be, if you are doing the audit of both the director himself, say by finding his return of income or managing his financial affairs, and also doing the audit of a company as an auditor, if you accept a declaration that it is out of own funds, it will be wrong. If you are not handling those other things, but if you accept that declaration, then it is fine. Because then you can say that I am not aware what are these personal matters. But if you are doing both the things, you accept such a declaration, in my view it would be wrong. Either you stop doing the other financial matters of that director, or you tell the director that this is not going to be an exempt deposit as such. This is also not covered as deposits. If you are issuing bonds or debentures which are secured by a first or a pari passu charge of any asset referred to in Schedule 3, which is your list of we alluded to that earlier, Schedule 6. So if there is any asset which is there in Schedule 3 and you are having a loan which is secured by that asset, then also this is exempt. Or the bonds or debentures are convertible within 5 years. If you take deposit from an employee not exceeding his annual salary under contract of employment as non-interest bearing security deposit, then it is exempt. It is now very clearly said it should not exceed his annual salary, it should be under contract, and it should not bear interest. Then only it becomes an employee security deposit as such. This is a new thing which has come in. Advance in course of business for supply of goods or supply of services to be appropriated within 365 days. So if I received an advance from a customer either for supply of goods or for supply of services in future, it is not covered as a deposit if I appropriate that within 365 days against the goods which I will supply or against the services which I would render as such. Now this is a difficult provision to comply sometimes in practice, and this is something which even for 13-14 accounts you have to be careful. Take for instance a very simple thing that we have got a customer to whom we have sold goods of say 5 lakh rupees. The customer says that you have supplied me goods which I don't want, so some of the goods I am returning of say 1 lakh rupees, but the money you can still keep it, in future I am going to still buy goods from you. So he returns money of say 1 lakh rupees to you, and you actually say that okay, I supplied goods to him of 4 lakhs, but he has paid me 5 lakhs and he has told me that okay, you keep that 1 lakh as an advance for my future supplies which I will take from you. Now that 1 lakh rupees I can keep only up to 365 days. Beyond 365 days it will automatically get covered as a deposit, and my deposit rules will start applying to you. So this is going to be harsh on people as such. Now think of situations where you have got 500 customer accounts. There are a lot of round off figures which are there, that there are 10 rupees left out, 100 rupees left out in the customer's account in the credit side, which are sometimes going on from years together. Now all that you cannot carry on beyond 365 days. So what we are advising clients is, in this accounts of 13-14, please write back everything of such things to income. You can pay it back to your customer whenever he demands it. Otherwise, even that small 100 rupees which is lying more than 365 days can trigger this deposit rules for you. It doesn't trigger in the March 14 accounts, but if you don't think about it now, in March 15 accounts automatically it will become a deposit. So then it has gone beyond 365 days as such. And 365 days you have to be actually careful. In a leap year it ends on 30th March. It doesn't end on 31st March. So they are not saying 1 year, they are clearly saying a period of 365 days as such. Okay. Lot of other difficulties which people are facing. Take for instance this jewelry industry or the diamond industry. Most of the jewelers, including big companies like Titan and all, have schemes that if you pay 11 installments, we will give you the 12th installment free, we will give you a gold coin free, and so on. We have got schemes of other jewelers who say that okay, you pay 22 installments and we will give you 3 installments free, after which you can buy the gold or take back your money or whatever. Now all these schemes are nothing but customer advances. Now all these schemes will have to be terminated within 365 days. Otherwise deposit rules start applying to you. And if you have seen in the last 2-3 months, most of these jewelers have remodified their schemes to bring it down to 365 days. Because otherwise you are just hit by the deposit rules as such. So lot of these are unintended things, but these are automatically hit by this provision of advances to be settled within 365 days. Take the case of builders. You have taken advance for a flat and you are keeping that advance for more than 365 days. That is also hit by this particular provision unless you really appropriate it against something fully or partly. Which means that you will have to start showing that income statement. You cannot say I have kept this advance for 10 years and after 10 years only I am putting the income. In other words, it indirectly pushes you to that percentage of completion method. So you are not now going to wait till the end and then say only then I will appropriate, because then you will have repercussions in the Companies Act itself as such. Forget your Income Tax Act as such. If you have got any advance in connection with consideration for property under an agreement, you have to adjust it only against it. Luckily here there is no period given, but you cannot adjust it anywhere else. It has to be adjusted only against that particular property. If you have got advance under long-term projects for supply of goods, that is also not covered, but whenever the amount becomes refundable with or without interest and it is not refunded within 15 days, then it is deemed to be deposit. So we have this retention money which is there. There is a period for retention money. So that is allowed. Till that period of retention money, it will not be considered a deposit. But once the retention period is over, within 15 days you have to repay it. Otherwise it will get covered by this deposit rules as such. So things are stringent, things are difficult, and that is why I said this is one section which even for 13, 14 you will have to be careful, because whatever action you want to take can be taken only now. You cannot hold on till the next year to take all the action or the remedial steps which you will need to take for the next year. If any promoters or relatives are bringing in unsecured loans pursuant to the stipulation of a lending agency, those are exempt. However, these are exempt only till the loans are repaid. So till you have got a loan of 1 rupee of that bank remaining, this loan from relative will be exempt. The moment you repay the loan, it becomes a deposit. So what that means is you will have to repay the both simultaneously. You will have to write a check to the bank, at the same time you will have to write a check to all these relatives, because otherwise from the very next day it will get covered as a deposit as such. And if anything is accepted by a needy company, they are exempt, but this is mainly applicable only in the southern cities. Section 73 talks of prohibition on acceptance of deposits from the public. Now when we talk here deposits, we are only talking of deposits which are not exempt. We have seen already what are exempt deposits. Here we are now talking about only deposits which are not exempt, which we have to fulfill some conditions of 73(1), 73(2), 74 and so on. Now when it comes to accepting deposits from members, which is nothing but shareholders, you have to comply with all these conditions. Now whether it's a private company or a public company, these conditions have to be complied with if you are accepting a deposit from the shareholders. So you have to obtain a credit rating, you have to deposit 15% deposits in a bank and so on. Insurance is there and so on is there. So conditions prescribed even for accepting deposits from members, be it a private company or a public company. For private companies, however, there is a draft notification, as we said, under 462 which was issued, which is subject to ratification by the Parliament, cannot be applied straight away. So they will ratify it in the budget session of Parliament. Section 73(2) will not apply to private companies if they have 50 or less members, and if they accept monies from their members not exceeding this 25% of the aggregate paid up share capital at free reserves or 100% of the paid up capital, whichever is more, and who inform the details of such monies to the registrar in the prescribed manner. So obviously this particular section which was there was hitting all private companies and public companies. Lot of representations were made, and the government was told basically that if you are not going to give any exemption to private companies from accepting deposits from shareholders, it will badly hit the entire private limited companies as such. The government came out with some reasoning saying that we know of several companies in India where there is a corporate member who is there. He is given one share, and that corporate member brings in 500 crores as a deposit, and in turn it is given out to a lot of people. So they have clearly said we want to stop this misuse of exemption given to shareholders from accepting deposits. However, they said to protect genuine private limited companies who are not involved in just this money borrowing and lending, we are going to give some exemption, and this is how the exemption has really come about in those private limited companies. So the restriction applies to all private limited companies. If you can get out because of this, it's fine. But this is a very limited exemption which is there as such, because it covers your private limited only if you are less than 50 members. Now private limited can have 200 members, but this covers only small private limited companies and not exceeding 25% of the paid up capital or 100% of the paid up capital, or free whichever is more. The companies which I talked about giving one share and borrowing 500 crore, their capital is 1 lakh rupees. And these are actual examples which the ministry has been giving to the people who are going for discussion. That we show you companies' balance sheet where 1 lakh capital, one share allotted to someone, 500 crores borrowed and given out to a lot of people. They say we want to stop this misuse of the concession on private limited companies accepting from shareholders. And that is why these restrictions have come. And if you look at what is this free reserves, Free reserves is not what you and I normally believe it is. Free reserve means something like this. Such reserves which as per latest audited balance sheet are available for distribution of dividend. There is a proviso, however, of that definition 243. This is not there in your slide. But this is a direct definition. I have not put anything myself on this. The proviso says any amount representing unrealized gains, notional gains or revaluation of assets is to be excluded from free reserves, and any change in carrying amount of an asset or liability recognized in equity, including surplus in P&L, on measurement of asset or liability at fair value. Both these things have to be excluded when I am calculating my free reserves. Now take that first thing, what is unrealized gains? If I have sold something on credit and I have not yet received the money, that is unrealized gain. So I will have to make adjustment for it when I calculate my free reserves. If I am doing an adjustment of AS 11 of my export receivables, that is the notional gain, because I have not really received that money, it's a notional entry I am passing. So free reserves is not automatically what comes out from your balance sheet. You will have to make some adjustments to your free reserves to decide what is the quantum of the borrowing you can make from shareholders even in a private limited company as such. Okay? Let's go back.
The second point.
You want to see the second point? Second point is more to do with IFRS. That's why it is not. Any change in carrying amount of an asset or liability included recognized in equity, including surplus in P&L or measurement of an asset or liability at fair value. Now, in India we have no standard today which allows you measurement at fair value, but Ind AS allows it. Ind AS whenever it comes it allows it, and the thought process in the ASB is now to upgrade the Indian standards to introduce fair value. So as and when that comes in, the second thing automatically will get triggered. That if you are valuing say your investments which are current investments at fair value, and whatever is the profit which is taken to profit and loss or equity without realizing that profit, that also is not part of free reserves. That is what the implication of that second point is. But that will still take time to trigger, but that really means you are following the IFRS or Ind AS principles as such.
So surplus in profit and loss account will not be.
So if this anything is on fair value which is either shown in
Not the second part, otherwise surplus in profit and loss account balance carry forward in
that is part of the reserves.
That will be part of it.
So that is reserve as per your that's a view which people say that if I have just got surplus in profit and loss account, it is not a reserve, but it is available for the dividend.
Yes, sir.
So I think the view, broader view which at least I would hold is reserves would include a surplus in profit and loss account, but you still need the other two adjustments which are made as such. Okay, so this is the exemption given to private limited companies. It's a draft notification. 99.9% it will go through, but don't take it for granted. Don't advise the client, as I said, before it is passed in the parliament, because the consequences are too severe by chance if it doesn't pass through. If the section continues where a company does not secure deposits or secures them partially, they are called unsecured deposits, and you will have to quote in all this circular everything that they are unsecured deposits. This is to protect the depositors, that the deposits are either secured or unsecured. If you fail to repay any of this, you can apply to the tribunal for any order to pay the amount with damages or some such thing. And there is a deposit repayment reserve account which the tribunal can then order to create, which can be used only for the purpose of repayment of deposits. What happens to deposits accepted before 1st April? And this is where again private limited companies who have taken deposits from shareholders have been badly hit. It says if you are accepted deposits before 1st April 2014, you have to file a statement of all deposits and any sum remaining unpaid with interest payable thereon. What is the arrangement for repayment with the registrar within 3 months from 1st April 2014. That is why people are scrambling to file that return before 30th June. It is some MD1, MD2, some name is there. So people are have to file that return before 30th June, that if you have got deposits from shareholders which are now not exempt in view of this, how are you going to repay them? And you don't have to repay them in 3 months, but you have to at least file with them how you are going to repay them and what arrangements you are going to make to repay those deposits. In other words, the registrar will be informed as to what are the amount of non-exempt deposits.